Welcome to the Radio Who, What, Why podcast. I'm your host, Jeff Schechtman. Think about the legal education we've all gotten recently. Things we know today that we didn't have a clue about 2 years ago. On the plus side, many of us better understand the Constitution, the rule of law, the rules of impeachment, and the separation of powers. Did you ever know about the Logan Act, about conspiracy versus collusion, about counterintelligence versus criminal investigation, about what really constitutes obstruction of justice? It's all been like living in a John Grisham novel. Thanks in part to the press and dozens of retired U.S. attorneys appearing on television, we all understand aspects of the law that we didn't have to go to law school to understand. Now a new arena has entered our Trump-era vocabulary. In the New York Times story last week about Trump's cash and tax losses, we've now entered the realm of learning about the world of commercial real estate and its dizzying complexity. As we go through the looking glass, we will certainly learn more about Trump and his taxes, but we'll also learn about carry-forward losses, badges of fraud, LLCs, and a whole new vocabulary with respect to finance and taxation. I'm joined in this week's Who, What, Why podcast by Martin Sheil. Martin's a retired branch chief of the IRS Criminal Investigation Division, a former contributor to Who, What, Why, and he joins me to talk not just about Trump's taxes, but about the whole backdrop of commercial real estate taxation, both legal and illegal. Martin Sheil, thanks so much for joining us.
Well, thank you, Jeff. Thanks a lot.
One of the things that I don't think people fully understand, to sort of kick this off, is that in that New York Times story last week, it wasn't the tax returns per se that the New York Times had access to, but in fact transcripts. Explain first of all what that is, what it is that we got a glimpse of.
The New York Times article of May 7 documented approximately a $1.2 billion loss by Donald Trump over a 10-year period. Yet these losses didn't come from the tax returns themselves. The reporters didn't actually have possession of Donald Trump's personal Form 1040s. What they used were transcripts of those returns. The IRS has, the ability to computer generate transcripts that are a line by line, essentially a copy of the numbers enumerated on the tax returns. But these transcripts are called IDRS transcripts. They don't include the underlying schedules that might explain or at least clarify a little bit as to where the New York Times reporters came up with these big losses. The New York Times reporters just basically have bottom line numbers. They don't have any supporting documentation for these losses, and to really fully understand where they come from, you need those schedules, and more than that, you need the underlying accounting work papers and files and notes and et cetera to fully understand that.
Even from the numbers that were there, Martin, is there any reason to think that fraud was somehow involved with this?
You would think, that just the average Joe would think that, well, there must be fraud involved here to have over $1 billion in losses over 10 years. But the way the tax code works, and particularly the way it's slanted in favor of some of the special interests like the real estate industry, that it's not uncommon for major players in commercial real estate to generate these types of losses. My interest is in Mr. Trump's potential for committing financial frauds. And to understand that, at least from the perspective of a criminal investigator like myself, we have to talk a little bit about the difference between a civil assessment that comes from a tax audit and potential criminal prosecution for tax fraud that could ultimately land the target in jail.
Is there a way to ascertain whether fraud had been committed from the top line numbers, from the numbers that the New York Times had that you were talking about a moment ago? Could that top sheet, could those transcripts give us an insight into any kind of fraud, or do we need more material to understand that?
Oh, no. The transcripts are just going to reflect numbers. That doesn't tell you anything about what the intent of the taxpayer was in terms of how they structured the tax return and what their objective, their purpose was. I think those New York Times reporters did a wonderful job in documenting the immense losses, but they did not pin down badges of fraud, the intent necessary for a prosecutor to actually prosecute for potential tax fraud. These same reporters, though, have done a wonderful job in a previous New York Times article. They honed in on a gift tax evasion fraud scheme perpetrated by the father of Donald Trump. And this scheme was actively aided and abetted by Donald Trump. And it really demonstrated a predisposition on Donald Trump's part to commit financial fraud.
The other part of this that I'd like you to touch on is the difference, because people talk about fraud with respect to taxes, is that there's civil fraud and criminal fraud, and also talk a little bit about the difference between the two as it relates to what we know so far.
What I'd like to do is talk about the badges of fraud, which there's many, and these have been yielded by various fraud prosecutions that have gone into court, and the court basically has determined what exactly is a badge of fraud. And when we talk about badges of fraud and the differences between fraud and say a civil tax assessment from an audit, we really are talking about how the government must document evidence of willful intent. What was in the mind, on the head of the taxpayer when returns were filed? And the evidence of this corrupt intent or this evil intent usually displays itself through such badges of fraud as the use of shell companies to conceal financial improprieties, use of fictitious invoice schemes used to disguise or misrepresent financial activities. Sometimes some folks use a double set of books or even 3 or 4 sets of books or records, depending upon their situation. And then there's the falsifying of financial statements. Each of these instances would reflect an overt act made by the taxpayer and or his accomplices to intentionally, purposely falsify entries on the tax return, to mislead anyone who looks at it. And sometimes when some folks get audited, they get hit with a big tax assessment, sometimes even a penalty, because they misunderstood the law, or they made an arithmetic error, or there was just some sort of oversight. There was a change in the law that they didn't catch, and they just kept doing it the same thing year after year. Well, that's accidental. That's not purposeful. It's not willful. And that's the difference. And the difference between civil fraud and criminal fraud is essentially civil fraud. You can get hit with a monetary penalty up to about 70% of the tax deficiency, and that's a pretty big hit if you're talking in the millions of dollars. Whereas a criminal fraud, you're looking at going to jail, as well as getting hit with all the monetary penalties.
What is the difference between an individual having this civil and or criminal liability and a corporation having that liability?
Obviously, the corporation will not be going to jail, but certain people can be held responsible for the filing of, say, a false corporate tax return, a possibility of the Trump Organization corporate return having been falsified. And a number of people may well have been involved in conspiring to falsify that return and or aiding and abetting. And those folks may well have some criminal culpability and may well end up being prosecuted for conspiring to impede or obstruct, impair the IRS from ascertaining the correct amount of tax due and owing. And they could be looking at potential jail. I think I mentioned earlier that where did Donald Trump derive his attitude about the government and about the IRS and taxes. I think the New York Times really pinned it down in their earlier article when they referenced the Fred Trump, Donald's father, involvement in the gift tax evasion, where back in the 90s, Fred Trump instigated a fraud where he created a shell company called All County Maintenance, and then used this shell company as a conduit to essentially funnel most of his wealth, a large portion of his wealth, to Donald Trump. And we're talking about multi-millions of dollars. And he did this intentionally evading gift tax assessments in the millions of dollars. The way they made this happen was through a false invoicing scheme where the shell company was invoiced for millions of dollars for boilers or refrigeration equipment that simply didn't exist, or they inflated the cost of the boiler or the refrigerators a hundredfold, and then the difference between the actual cost and the markup ended up in Donald Trump's pocket. So multi-millions of dollars were transferred by Fred Trump to Donald Trump using the shell company and a false invoicing scheme. Well, here you have, badges of fraud. You have overt acts, the use of a shell company, the use of a false invoicing scheme to conceal the funneling or the transfer of wealth from Fred Trump to Donald Trump. This is not accidental. It's not an oversight or an arithmetic error. This was purposeful, willful. Unfortunately, the IRS did not catch it. They don't catch everything. And the statute of limitations has passed, and Donald Trump has, when you wonder where Donald Trump got his money to invest in casinos and hotels and stuff. But, also, I think Donald Trump's attitude toward the government and towards the IRS was also transferred from his father.
I want to talk a little bit about these losses that were reported, because there seems to be two parallel schools of thought on this. You hear a lot of people talking about the fact that these were normal losses that people in the real estate business and carry forward losses, the normal kinds of things that people did on their taxes, particularly back in those days. The other part of it is that a lot of these losses were not just tax losses, but they were losses of cash, in many cases money that came from banks through sometimes fraudulent means. Talk about that, please.
I look at it from tax law from the point of view of the honest, law-abiding, tax-paying citizen. When you first start off setting up a business, say a small business, it can be tough. You can incur losses for some time before, things turn around and you start making a profit. And the government recognizes that and wanted to assist small businessmen and big businesses too, in terms of being able to absorb losses and not, bankrupt the company, but allow them to, hang in there until some things can change. Now, in doing that, they legislated some tax benefits, which I guess we can refer to as allowing folks to take what's known as a net operating loss, the acronym being NOL, and sometimes allowing the business to either carry back or carry forward some of these losses to apply against income from other sources and whatnot. So that the business wasn't being penalized twice. First, from the shock of some sort of economic recession or something that is negatively impacting their business, and then having to pay tax on top of that. So the government was trying to help business out a little bit. Now, some will complain and point out that special interests sort of took over and had an undue influence over the tax legislators, and provided some special type of benefits to certain industries, and that certainly is point well taken, and it's arguable. But certainly real estate has benefited a lot from the House Ways and Means Committee legislating special deductions and losses for the real estate industry. But having said that, going back to that $1.2 billion in losses over a 10-year period, understand that in commercial real estate, these businessmen, invest as little of their own money as possible, but in almost every instance will attempt to convince or persuade the big banks to provide financing. They will pitch them a deal where they will suggest to the banks that this is going to be a giant profit-making, money-making venture, and assure the banks that their loans will be repaid with interest, lots of interest, and so that the banks then see it as a profit-making venture. So what happens then, particularly with a businessman like Donald Trump, who's, let's face it, he's a salesman, he's a little bit of a huckster, some would say a con man. He will persuade, and he did persuade banks for years to lend him multi-millions of dollars for investment in commercial real estate, whether it was office buildings or hotels or apartment buildings, wherein he would sell luxury condominiums. Trump kept losing money on all these ventures. He just was not a good businessman. He declared bankruptcy something like 6 times with his casinos, which that's pretty hard to do considering the cash flow of a casino. But it happened, and the banks somehow were persuaded by Donald Trump to continue to invest in Donald Trump's ventures. And one of the ways Mr. Trump did this was by providing the banks with these financial statements, which were just false. Is the only way to put it. Michael Cohen famously talked in his congressional testimony that Donald Trump inflated the assets on his financial statements to Deutsche Bank when he was looking to buy the NFL franchise, the Buffalo Bills. And he inflated his assets by something like $4 billion in almost a ludicrous fashion, when from one year to the next, his financial assets went up by $4 billion. And Trump attributed this increase to the branding value of the Trump name. And he had no other evidence to support this. And that should have been, the bankers should have just laughed at that, as opposed to giving that serious consideration. But this is what he does.
What is the nexus from a legal point of view, an accounting point of view, between false documents that one might give to a bank in order to secure a loan, as he did with Deutsche Bank, and the actual reporting that goes on to the IRS? Is there a nexus between the two? Is there any reason the two should be consistent?
Well, there should be a nexus. Most businessmen, honest businessmen, will maintain one set of books and records, one set of financial statements and documents, whether it's for the banks or whether it's for the IRS or whether it's for some other taxing authorities such as property tax folks, New York City Finance Department. Yet it appears that Donald Trump makes use of more than one set of books and records, or certainly more than one set of financial statements. And it depends on the situation. That $1.2 billion of losses that Times reported Trump incurred over a 10-year period, an awful lot of that $1.2 billion was not Donald Trump's money. It was actually the bank's money. So Donald Trump had hoodwinked the banks into providing them these millions and millions of dollars, which Trump would then lose. But because of the way the tax law is set up and the use of limited liability companies and flow-throughs, partnerships, and subchapter S corporations, Trump could actually claim much greater losses than what he personally lost out of his own pocket.
Why would the banks not want to see his tax returns?
In fact, most banks do insist on seeing tax returns if you and I went into a bank and asked for a loan to start up a business or to buy a house or a rental property, something like that, most banks would insist on, well, let's see your last couple of years of tax returns. And that's part of the record, the part of the loan record. Yet, because of the way the tax law is, many commercial real estate folks are able to generate negative income or through net operating losses, through depreciation, through investment credits and special type of tax allowances. So the banks probably are not too unimpressed by big businessmen showing a lot of losses. They're more interested in seeing actual financial statements because the bank will always be looking to, well, what happens? They'll ask themselves, what happens if this venture goes south? Can we get back our money that we've lent? Is there some collateral, some asset that we can go after to make ourselves whole? So then what they should do, if they're doing their due diligence when making a loan, is to scrutinize the financial statements provided them by Donald Trump and his accountants and make sure that those assets are true in terms of their value. Unfortunately, in the 80s and 90s particularly, it appears that the banks either did not do their due diligence or the whole thing was a wink and a nod. They just wanted to be in business with a famous businessman, or they felt that they could make up their losses in some other fashion. I can't really answer for the banks. I really hold them responsible for over and over providing money to a businessman who's just a big loser, who's just losing, money in venture after venture. There's no basis continuing to loan him money.
If you listen to all of this and understand all that we've been talking about, it seems like this is the most fertile ground imaginable for money laundering. Talk about that.
Well, yeah, it's been well known that for years that commercial real estate and particularly the selling of luxury condominiums in big cities such as New York or Miami or LA would provide a vehicle for folks who wanted to launder their money from some ill-gotten gains, whether it was, racketeering, Russian organized crime or South American narcotics traffickers or, any type of gambling or loan sharking. Or what was big in New York back in the 80s and 90s was when the Russians came in was fuel excise tax fraud. You can't believe the amount of money involved in scamming the excise tax on when you tank up your car or your truck. There's excise tax on every one of them. You don't pay that excise tax, you can make a lot of money. And some of the Russian mobsters and Italian organized crime was also involved in this, and they made a whole bunch of money. The reason I mention that is because there are some famous characters that Russian-based that bought dozens of condos in Trump Tower in Manhattan, as well as in Miami. And they would pay frequently. They would pay with cash. So here you have, say, a Russian mobster, selling drugs or skimming fuel excise tax fraud or whatever, who is flush with money from some sort of crime, is looking to clean that up, and says, well, what can I do? Buying a luxury condo in Trump Tower for cash was using a shell company, thereby guaranteeing anonymity. Well, there wasn't a better money laundering deal anywhere. So when folks talk about offshore and Switzerland and whatnot as places that launder money. In the last few decades, really the old USA, particularly the big cities, particularly residential and commercial real estate, was the place to go to launder large amounts of money because of the way the law is set up. That there was no insistence on knowing the ultimate beneficial owner of a shell corporation that would purchase, these condos in Trump Tower. The cash would come from some anonymous person through a shell company, end up in an escrow account of an attorney in New York City, and then that money would go over to, say, the Trump organization, or more likely to one of Trump's shell companies. In fact, who knows? Maybe it didn't even go there. Maybe it went into some other offshore account and was never reported. So what you have when you're selling luxury condos in New York City for multi-millions of dollars through the use of shell companies was, really just a lack of accountability, and so made for an ideal way or mechanism to launder lots of money.
There's been a lot of talk about the 50-something million dollars in interest that showed up on one of these returns, right, and where that came
right.
from. And the assumption has been that somehow that was connected to money laundering. What is your take on that?
Because we only have little bits and pieces, it certainly lends itself to speculation. And I always say, let's break it down. Break it down into bite-sized pieces so we can understand it some more. And as I understand it, I think it was 90 or 91 that Donald Trump suddenly reports, let's say 51 or 50, maybe it was $53 million in interest income, where in prior years there was no record of anywhere near that type of interest income being reported. So suddenly, he came into a lot of money. Now, this is right in the middle of the period of time where the Times said that over a 10-year period, Donald Trump had lost $1.2 billion. So, okay, let's think, how do you make $51 or $53 million? I would suggest it either has to come from a bond, but that's unlikely. It's the most likely source of income, and these transcript does not show the schedules, and so we don't know. So right now I am speculating, but it's kind of an informed speculative opinion here, that the likely source of the $53 million interest was likely a large loan that Donald Trump made to another individual or to a business or to a consortium. And when you break it down, I don't recall what the interest rates were back in 90, 91, but just for your listeners' ease of mind, let's use large rounded numbers here. I would suggest to you that an interest rate of 10%, maybe 10% and change, of a $500 million loan, that's $500 million, that would come to about $51 to $53 million in interest. So this is Donald Trump being a lender, lending out $500 million and getting $51 million interest. That flies in the face of everything we know about Donald Trump. I mean, Donald Trump is a borrower. He's not a lender. Donald Trump is a taker. He's not a giver. So yeah, there's a possibility that, Donald Trump received a large sum of money from someone else, decided to sit on it for a year or two and, made use of it, and then it disappeared. So we don't know, there was no indication of that same size amount of interest in the following years. Yeah, if you want to speculate, yeah, sure, it's possible that that this could come, that $500 million came from some illicit source, but I don't really know. And Donald Trump has got a host of issues. He's going to be looking at a host of criminal suits, I think. And he's probably still got to deal with some of those real estate transactions where he wasn't paying his property taxes. He would use we talk about how he pumped up his financial statements to get loans from the bank, but then he would provide the New York State finance department, the real estate folks, with minimal deflated type of financial statements to minimizing the value of his properties and assets in an effort to minimize his property taxes. And this is nasty stuff. New York City Finance Department, they derive 40 to 45% of their revenues from the collection of property taxes. So when you evade property taxes, you are really hurting New York City.
Are the real estate tax laws as loose today as they were during this period in the 90s that we're talking about?
No. I think there's been some tightening up in terms of the shell companies. Years ago, you have all these Russians coming in and buying condominiums in Trump Tower anonymously through shell companies. Well, that has been addressed. The ultimate beneficial owners or buyers of these condos now have to be identified. So that's been tightened up a little bit. Still, the use of shell companies in real estate is just, it's everywhere. It's endemic. And there are, I would point out that there are legitimate uses for shell companies. Real estate, if you're into real estate, and you own a number of houses, say, or apartment buildings and whatnot, it makes sense to put each property in its own limited liability company for the purposes of risk management, minimizing your exposure to lawsuits. You don't want to have all your properties subject to one lawsuit. So if you can minimize your exposure, that makes sense. And let's face it, there are awful lot of lawsuits between tenants and landlords. And so that's a smart way to go about it. Now, it has been abused, and they've tightened it up somewhat. But Donald Trump, on his last financial disclosure statement that he has to make as president, he indicated ownership of approximately 500 shell companies, or LLCs, limited liability companies. That is just an awful lot, But it's not unusual for someone who of his ilk in terms of real estate holdings. It's just an awful lot for any one regulatory authority to keep track of everything. It's just hey, let's face it, IRS has lost quite a bit of resources and personnel over the years from attrition, and it's hard for any one auditor or investigator to be able to just take a look at one set of financial statements or tax returns that probably comprise hundreds of pages and be able to make sense of it without spending an inordinate amount of time and effort.
Knowing the IRS as you do, and from strictly a tax perspective, do you have a sense that any of this will be prosecuted?
I hope something is done tax-wise. The fact that the banks might have lost some money, I'm not going to lose any tears over that. What does bother me is when Donald Trump plays games with the tax authorities, and he refers to it as, making sport. Churchill once said that taxes are the price we pay for a civilized society. No one likes to pay taxes, but we do it in the course of fulfilling our civic duty to voluntarily comply with really the greatest tax system in the world. This system corrodes, however, when one of the richest and most famous members of our society pays little to no taxes and makes light of this civic duty, suggesting tax evasion is nothing more than sport. There's no OLC opinion from the Department of Justice that provides President Trump with a free pass from paying his taxes, whether he's president or not. Spiro Agnew, when he was vice president in 1973, was prosecuted for tax evasion by the U.S. Attorney's Office in the District of Maryland. Agnew pleaded no contest to a single count of tax evasion while in office and resigned. I guess my feeling is if President Trump participated in a tax fraud scheme in the past few years, then IRS and DOJ need to fully enforce the tax law in order to maintain the integrity and viability of our voluntary tax compliance system. If not, then Leona Helmsley's famous statement will have been confirmed as correct. When she was referring to her wealthy contemporaries in the real estate and hotel business, she famously said, "We don't pay taxes, only the little people pay taxes." So as a proud little person, I sincerely hope Leona Helmsley is wrong.
Martin Sheil, I thank you so much for spending time with us today here on the Radio Who, What, Why podcast.
It's my pleasure, Jeff, as always. Good luck.
Thank you. And thank you for listening and for joining us here on Radio Who, What, Why. I hope you join us next week for another Radio Who, What, Why podcast. I'm Jeff Sheckman. If you like this podcast, please feel free to share and help others find it by rating and reviewing it on iTunes. You can also support this podcast and all the work we do by going to whowhatwhy.org/donate.